What is the Credit Suisse call on the U.S. dollar?
Morning. We are looking for a weaker dollar linked to some of the points you've already made. Firstly, we do have a situation where the Fed is still buying, in effect, around $80 billion a month of treasuries, and the balance sheet expansion is continuing with maybe slightly slower than the peak levels that we saw, but still by any historical standard at a fast pace. You also have still talk of yield curve control. Our rate strategist, for example, thinks the market is still pricing in around a 40% chance of yield curve control being introduced in the U.S. within the next 3 months. Some feel that the Fed has already decided to do that, and it's just a question of working out implementation. So these factors, together with very low nominal rates, we talked about real rates, but nominal rates are also very low, obviously, and so yield differentials, even in nominal terms, do not preclude being short dollars these days, unlike the last few years.
And folks, for those of you on our simulcast, this is really important how we fold in our conversation of yesterday with James Bullard over to the foreign exchange realities of Shahab Jalinoos. On yield curve control, Shahab, do you just assume that means lower and longer at the zero bound? And as John Farrow mentions, the interest rate market must adapt to that, and that's expressed in your world of foreign exchange.
I think that's right. I think in our world of foreign exchange, clearly real yields do matter in the long run, but in the very short term, nominal rates matter too. That's basically the real cost, the cost of carry that you pay for being long or short a currency. And at this point in time, unlike recent years, the dollar in nominal terms does not offer any significant yield pickup, and yield curve control would ensure that would be the case going forward for a long time as well. So all of a sudden, currencies like the euro or the yen or the Swiss franc that have some positive characteristics, let's say from a fiscal perspective relative to the U.S. or from a current account perspective, they don't look so bad all of a sudden because now they don't have a negative yield differential relative to the U.S. dollar. So owning them becomes much more attractive, and I think that's the state of play that we're in right now.